All right, wings up, everyone, wings up, and welcome to our Wednesday night call, our product training call. I'm so glad to see everyone on the call today. I hope everyone had a marvelous day. We are going to get started and get the ball rolling. Today, we're going to be dealing with how to solve funding gaps. So you guys know that we have a plethora of different products and programs that we have to choose from, and you guys get to choose from. I'm sorry, just options under the G2 Global umbrella, under the G2 Global Network. So this is one of the products and programs that we specialize in, and we do a lot of funding. As a matter of fact, we're just literally just doing one right before this call, funding a client that needed unsecured funding. So it is definitely a great program to help when it's needed for real estate projects, or just having the need to need additional cash for business expenses, personal expenses, things of that nature. You guys can kind of think of some scenarios where a time where you probably didn't have the necessary capital to do exactly what you needed to do, whether it be for business or personal. Just think about those times and what you would have done had you had access, or how it could have benefited you had you had access to a number of different options for that capital. So, let me ask you a question. How many of you have been denied funding because maybe you didn't even have collateral? Okay. How many of you all have been denied funding because you didn't have collateral? How many of you all have been denied funding because there was no type of assets, or the credit just wasn't up to speed, and you were really in need of some funding? Okay, I don't know. Put it in the chat if you all have ever been in need to need funding but did not have the collateral to secure it. This is what unsecured funding does. Okay, unsecured funding removes the barrier that blocks you from not being able to complete a project because you don't have collateral. Okay, so unsecured funding removes the barrier so you can complete a project without you having to need an asset or to need collateral. Okay, so this is definitely a credit based lending program. This is not asset based. Um, Unsecured funding is referred to uh, as a high speed type loan, a flexible type loan. So people that know about unsecured funding know that they can get unsecured funding a lot quicker than being able to get it secured. Okay, a lot faster. Okay, so unsecured money refers to funding that is extended to an individual or even a business without requiring collateral. So, unlike secured loans, and you may hear that term secured, secured simply means it requires an asset like real estate or vehicles or some type of equipment. When you hear the term secured loans, that means that the lender wants you to back it by something tangible. They want you to back it by something tangible. So, unlike secured loans that require assets like real estate and vehicles and equipment, unsecured funding is based primarily on the strength of the person's credit. Okay, based on their credit profile, it's based on their income, and it's based on their financial histories. Okay, so lenders in this scenario are betting on your financial character. They're not betting on your assets. They're betting on your financial character. Okay, so strong credit in this scenario equals what? A strong borrowing power, gives you more borrowing leverage. So this type of funding can be used for, I don't know, anything: business startups, expansions, real estate investment, debt consolidations, things like that. Your credit program, your credit profile is your leverage. So the key components and the key characteristics to this unsecured funding is no collateral is required. It's approval based on credit worthiness, faster approval and funding timelines, and it's flexible usage, whether it's business, personal investments, whatever you want to use it for, you get to choose. Okay, you get to choose. All right, so that's the benefit of using unsecured funding. So why does that matter? It matters because unsecured money provides access to capital without risking whatever you have in terms of assets, without risking your home, without risking your vehicle, without risking your equipment. So you don't have to use that to obtain the loan. So making it it makes it one of the most powerful tools that people like us, entrepreneurs and investors and business owners who need money quickly. Okay? So who needs money quickly, right? So the types of loans or types of unsecured loans, right? There's several forms of unsecured funding that can be leveraged. All right. You have here's your common types of unsecured loans. So when you hear us talk about gap funding and unsecured money, this is what we're speaking of. Loans that does not require you to have collateral. Those type of loans are personal loans, business unsecured loans, lines of credit, credit cards, fintech lending products. We're going to talk about this in a second. And what's called peer-to-peer lending. Okay, so each type of funding serves as a specific role in building what's called a capital stack. You guys hear us talking about capital stacking and things of that nature, utilizing unsecured funding. Okay, utilizing unsecured funding. So sorry about that. The personal loans is just a lump sum funding with fixed repayment terms. All right. Personal loans are lump sum fundings with fixed repayment terms. Fixed means, and in the financial world, you guys that's been in our classes know that the terminology is called amortized. Okay, so it's amortized, meaning there's an open and a close date. This means that this loan was opened on this date, and according to the payment schedule, it's scheduled to end on this date. So that's called amortization. That is an amortized loan. So personal loans are lump sum funding with fixed repayment terms. Okay, but you can also get personal loans that's credit cards and revolving as well. But for personal loans, and for the most part, is a lump sum funding with a fixed repayment term. So business unsecured loans, those are based on personal and business credit. So when you're talking about getting business unsecured loans, they want to look at the business credit as well as the personal credit. So when you're speaking with clients, or maybe you may be in the market for a business loan or business unsecured loan, you have to make sure that you've got established business credit and you have good personal credit. Okay, and we're going to talk about the criteria and what you need to have in order to get approved. Okay, so then you have what's called lines of credit. That's your revolving lines. This is still unsecured funding. Revolving credit that you can draw from as needed. You get a revolving credit line for 100,000 and you only want to use 10,000. Well, you're only making payments on the 10,000. So with revolving, it acts as a credit card. You get to use the money that you need and only have to pay back what you've used. Okay. And so then you're only being charged for what you use and not the entire line. So that's a lot more flexible to especially investors that like to have that type of flexibility and not incur the cost, such as a personal loan that's going to give you $100,000 and the payments is going to be on the 100,000. Okay. So a line of credit allows you to use 10,000 out of that 100,000 and only be charged on the 10,000. Okay. So then you also have credit cards. That's another form of unsecured loans. High limit credit cards. Okay. High limit credit cards. That's another way to get funding. And then you have what's called fintech lending products. All right. Fintech is financial technology. Financial technology. That's what fintech stands for. It's financial technology. Okay. And so this financial technology is lending applications or lending groups that approve you or deny you based on their financial technology, their data points. Okay, what is it? What is it going to require electronically for you to get approved? It's all inside of their system. So there's a data point system that's built into these fintech lenders that allows them to assess their risk. It's all embedded in their system. So it's all online. This is where you don't have to go into banks. You don't need to sit with a loan officer or anything like that. So we deal with a lot of fintech lenders as well as peer-to-peer lending. So that's borrowing from private investors via a private investor platform, which we have that as well with G2 Global Network. Okay, so yeah, once again, each type of funding serves as a specific role in building a capital stack, which allows borrowers to combine multiple sources for maximum leverage. Okay, what does that mean? Capital stacking. Capital stacking. Okay. Capital stacking basically means we're going to take multiple lenders and multiple programs, and we're going to stack those together in order to get a lump sum of money. All right. So here's what I want you all to understand, and I share this with people all the time. That I know we've got some cooks on this call here that follows the what we like to call the recipe, right? So when you're in the kitchen and you're cooking and you want to have a certain outcome on your dish, you want to make sure that you understand the recipe. So what I like to share with people often is it does not matter what you need in terms of funding. Okay, it doesn't matter what you need in terms of funding. You can get exactly what you need as long as you understand the recipe, right? As long as you understand the recipe. So the recipe is just like when you make chili. You can't make chili without beans unless you like chili without beans. But you can't make it without the meat. You can't make it without the vegetables and the other things that go inside that chili. Because if you miss some ingredients, number one, it's not going to come out right. Secondly, it's not going to be tasty. Okay, so it's the same concept when you're trying to get funding. You have to simply understand what that recipe is. What's the recipe? You want $100,000? You want $200,000? All you have to know is what the recipe is, and match those recipes, and that's how you get approved. Okay, so to qualify for optimal unsecured funding, the borrowers need to meet the following criteria. What we're looking for is at least a 680 and higher, 680 or higher credit score. So when you're talking with your clients And let me give you an example. They're trying to close on a real estate loan, uh, and they're short. I don't know. They're short 20, 30, 40, 50,000, 100,000, whatever it is, and they don't have a way to get the remaining balance. Well, this is your solution. Your mind needs to automatically, whether you're the agent or you're the client, your mind needs to go to unsecured funding. So that's what's going to fill that gap, right? So now your solution is, how do I make this gap complete? Okay. Is my credit score 680 or higher? Is my credit utilization 30% or less? Do I have no more than 4 inquiries within the last 12 months? Have I opened any new accounts within the last 6 months? Do I have at least 3 primary accounts, not authorized user accounts, but 3 primary accounts reporting to my credit over the last 2 years with the balance of 25 or a limit of $2,500 or more? That's the real recipe. Okay. That's the recipe that you're looking for to get optimal funding success. Okay. So as long as you understand what's required, then you can get exactly what it is that you need. This is the recipe. So then you say, well, okay, well, my client has a 6, I don't know, my client has a 650, right? And but their credit utilization is about 30%. They have maybe about 6 inquiries within the last 12 months. Okay. They don't have any new accounts within the last 6 months. And they have 3 primary accounts reporting to their credit. Now, based on the scenario I just gave, you got a 650 and you have 6 inquiries in the last 12 months, but you have everything else: income, job, all of the other things that we're going to discuss in a minute. Your mind needs to always be ticking in terms of, how do I pivot from here, right? This person has a 650. They have everything else. How do I fix this? Because remember, one of the things that we talk about with G2 is being a solution provider. The more that you understand how to fix things, the more, number one, your income goes up, the more your clients trust your ability to consult them. Because of the more knowledge that you have, the more equipped that you are to solving the client's issue. Okay, so where do you end up at? What do you end up at? Your mindset should be, I need to put this person into a credit restoration program, or I need to find out exactly what is causing her scores to be at a 650 and not a 680 or higher, because you want to get this deal done. Okay, remember, you're as an agency, you're at 4% commissions, right? So for every $100,000, you're making $4,000 on it. But that means that in this scenario, that you're only 30 points away from making that 4,000 or 8,000, whatever it is that we're going to get them. That's the thought process. Okay, so understanding the recipe and understanding your options, understanding how to pivot. All right, so it's a combination of things, which is why I'm teaching about the gap funding and all these intricate parts, because when you're talking with your customer, I want you to always have an answer for them. My goal is to give you an answer to say, hey, don't worry about that. We have an option there as well. Here's another option. Or you can do this. Now, eventually you're going to run out of options, but when you can give them more options in the beginning, that customer is going to be more likely to do business with you. Okay, so uh, personal loans, lines of credit, credit cards, those type of things all require typically the same recipe. The 680 or higher, the 30% or less credit utilization. You don't want to have any more than 4 inquiries in the last 12 months. None within the last, no new accounts within the last 6 months. That's something that you really want to ask your clients. Have you taken out any loans, any new cars, vehicles, credit cards, anything like that within the last 6 months? Why? Because you understand the recipe. You understand that the underwriter is not going to like that when they see it. So we want to make sure when we're talking with these clients that we're pre-underwriting these clients prior to getting their file and submitting them, right? We want to know by asking these pertinent questions. Okay, which is why it's great that you guys are in training. This is why, it's great that you continue to go back and watch these videos, because the more knowledge that you know, the better off that you're going to be. So with this recipe, the employment history needs to be a minimum of 2 years employed at the same company. One of the things that underwriters do not like, they do not like you switching companies or company hopping. It shows a lack of stability. So if you get a customer that's new on their job, or they've been at this job for 1 year, they've been at this other job for another year, they're kind of all over the place, that's going to be an indicator that this file might get declined. So you want to have consistent employment history with your client for a minimum of at least 2 years at the same company. You want them making a minimum of $50,000 or more a year. 50,000 or more annually. Okay. So residency, stability, 5 years or more at their current residence. So when you're doing them applications, you want to make sure that you're letting them know that you've been at this location for at least 5 years. What you're doing is what's called triggering data points. You're triggering data points. And when you trigger data points, you trigger data points because the system, remember, this is a computer that's underwriting, pre-underwriting, and pre-approving these applications prior to it getting on the desk of a human, if it makes it to a human desk. It depends on the lender that we're dealing with, right? Most of this is going to be done through computers. So you want to make sure that you are increasing the data points. You want to offset the risk assessment. You want to make sure that this particular client through the door is going to get an offer. Okay, so 5 years or more at their current residence. If they're self-employed, you want 2 years of income taxes, 3 years of bank statements, and profit and loss statements for the previous years. You guys are going to get all of this in a handout, by the way. Okay, so 2 years of established business credit for self-employed. So you have to know the difference when you are dealing with your clients. You want to know, are you employed or are you self-employed? I'm going to be honest with you guys. I don't really like doing unsecured funding too much for self-employed. I'm not saying that we can't do it, okay? We do it all the time. And literally just got an approval now while we're on the phone, just now, literally. Okay? So we do it all the time. But here's the issue. The issue is when it comes to underwriting for business funding or business unsecured funding especially, remember, the underwriter's job is all about risk minimization. Their job is to minimize the risk. Being in business and self-employed, your risk goes up tremendously according to underwriting risk assessment. You're self-employed. No one's giving you a check. You're only getting paid based on the performance of your business. Your business goes down, your income goes down. Your business goes up, of course, it goes up. So underwriters underwrite businesses, self-employed people, a lot different. And one of the big things that always gets businesses in trouble when it comes to them trying to obtain funding is their taxes. It's the taxes. Most businesses, when they're filing taxes, they're not filing their true income, right? Why? Because they don't want to pay taxes on all of that income. So, and lenders want to see your true income. So at the end of the year, they're looking to see what did this business profit. And as a business owner, if you're showing that you didn't profit that much and you came out, you know, only made $20,000-$30,000 that year, when it's time for you to get a loan, and the underwriters look at your your taxes, your tax returns, they're going to see that your business only netted $20,000-$30,000. So they're going to go based on that. Even though your bank statements show that your income is at $100,000 per month, they're going to go after those taxes. So what we have to do in cases like that is we have to go to lenders that will allow us to do what's called stated programs and not have to prove your taxes. Okay, so that's where we come in at knowing what lenders to go to, what lenders are going to allow us to do certain things. That's why you're with G2 Global Network, and that's what your client pays you to do, because the consumers don't know this. They don't know what lenders to go to. We have a list of lenders that we deal with on a regular, right? They don't know where to get this money from. If they did, they wouldn't be paying you, right? They wouldn't be coming to you and saying, hey, I need to get some money, but I don't know what to do, right? So, you want to make sure that when you're dealing with your clients, that you ask the question whether or not they're self-employed or whether or not they're W-2. W-2 employees tend to have the better success because they get direct deposit, they get their checks on time every 2 weeks, every week, or whatever the frequency is. You know, they've been at their job for X amount of years. So the underwriters, it lowers the risk minimization, the risk measurements. Sorry, it lowers the risk measurements for that particular client. Okay, so I like W-2 clients better than self-employed. But all of them are good. Okay, they're all good. All good. All right. So, uh, here's the lending advantage that you have. Our relationships are with nationwide banks. Our relationships when it comes to our unsecured funding are with credit unions and, once again, fintech lenders. Okay. So we are not the lender. We're the connector. What does that mean? What does that mean? We're not the lender, but we're the connector. That means that we're going to be able to get you access to multiple lending sources all at the same time. Okay? That means that we have the ability to match your client with the ideal lenders based on their scenario. That means because of our leverage and the number of lenders that we work with, it increases our approval odds for that particular client. So, and then of course, the ultimate reason, which is why we do the capital stacking, is you get higher total funding amounts. Trying to go to the bank to go and ask for a $200,000 or $300,000 loan, good luck. I'm not saying that you can't do it, but you better make darn sure that you've got everything together. You've got your taxes together. You've got your books together. You've got your income together. You've got everything all the way down to a T before the bank would even entertain giving you a loan for $300,000 unsecured. Okay. So what people do is they rather pay the higher back end fee to do a capital stack program and that to get those higher amounts and increase their odds by doing it that way, by way of capital stack. Okay. So instead of applying to one lender at a time, G2 Global creates a strategic funding ecosystem around each client. Our implementation team, gets on a Zoom call with them, okay? And we do everything the same day. We do all of the funding the same day in terms of the application. And most clients are funded with money in their account within the next 7 days, okay? So the definition of this capital stacking, the core concept of this, okay, it's a strategy. That's all it is. It's a strategy of combining multiple funding sources to combine the total amount of capital that the borrower needs. Okay, so it's a strategy of combining multiple funding sources so that client can maximize the total amount of capital that they need, that they can access. Okay? So all we're going to do is in our pool of relationships, we're going to apply multiple lenders across our different institutions based on their criteria and based on what they need. Okay? Some of them can go to credit unions. Some of them can go to traditional banks. Some of them can't. Some of them can get approved through fintech lenders where they can't go through a traditional bank, right? So it just depends on what their criteria is. So uh, it secures approval simultaneously and the layer funding sources all together. Just to give you an example, you can do 25,000 in personal loan, 50,000 in line of credit, 30K in business loans, and 20K in credit cards. It gives you like 125 in capital that you need. Okay, so the bank says no, we won't give you 125,000 in capital, but the fintech lender say, hey, we'll give you 25. Another lender say, hey, I'll give you 50K. Another lender may say, hey, I'll give you 20K. I'll give you 30K. The problem is the customer and the consumer do not know how to do this process. There's a strategy to this. Okay? There's a strategy to it. There's a 20% back end fee as well, success fee, to get capital stacking done in 7 days. 7 to 14 days is max to get this type of capital. Okay? Keep that in mind. All right? So, why is it needed? Once again, one lender alone won't often meet the full lending needs. Large projects require multiple sources of funding. It's going to help avoid over reliance on a single lender. It maximizes borrowing power efficiently. So capital stacking allows clients to scale faster. It allows clients to invest smarter, and it allows clients to operate with stronger cash flow positioning. Okay? So instead of asking the lender for 100,000, we just get multiple loans from multiple people. Right? So just keep in mind, we don't chase one big approval. That's one thing you don't want to do. We don't chase one big approval. We build multiple approvals that add up. That's the source. You don't chase one big approval. You build multiple approvals, and it adds up. Okay. So you hear the term when we talk about all the time, it's simply gap funding. That's all this is. This is gap funding. So when you hear us say that, hey, we have gap funding available, this whole capital stacking and unsecured funding, all it is gap funding. Gap funding, the definition of that is capital that's needed to cover the difference between what you have and what you need. You need to fill the gap. You need to complete a deal. You need to complete a project, whether it's in real estate acquisition, who's trying to buy properties, who's trying to close on their properties right now. Let me share this with you that you know that we have funding deals. Okay? We have funding deals for real estate. Just say someone wants to buy a commercial property, a 4-unit building. You know that based on the guidelines, and we'll talk about this later, and in our real estate training. But typically, the lender is going to come in on our end, maybe about 80% loan to value. That's how much they're going to give you. Okay, so if the building is 100,000, the lender is going to give you 80,000 of that, which means that you have to come to the table with $20,000 of your own money. All right, so we got you covered with the funding from the lender. You've got to come to the table with $20,000 of your own money. Well, I don't have $20,000 of my own money. What do I do? You use gap funding. This is unsecured funding. So based on the criteria with your client, right? They need to have a 680 or higher credit score because they need $20,000 now. Mr. Customer, what's your credit score? Is it 680 or better? What's your credit utilization? Is it 30% or less? Mr. Customer, you don't have more than 4 inquiries in the last 12 months, do you? Customer says, no, I'm fine. Have you taken out any loans or anything new within the last 6 months? New credit cards, vehicles, any type of loans? No, I have not. Great. Do you have at least 3 primary accounts reporting to your credit? Yeah, I've got a lot of accounts. I've got 5 or 6. Perfect. My credit score is a 720. Perfect. Right? So now, in your mind right now, okay, are you working or are you self-employed? I'm W-2. I work a job. Excellent. What's your annual income? You see? My annual income is $70,000. Excellent. So you're underwriting in your mind as you're asking these questions. So they just, you just have to you just have to know that you have to know that the solution is based on their credit profile. The unsecured under the unsecured program. So because they're trying to close a real estate loan, they've got business expansion. They're trying to they need money for working capital, investment opportunities. This, whatever it is. Okay, gap funding can solve that problem. So now in that particular scenario, the lender has brought to the table 80,000, and now we just found them another 20,000 in gap funding. How much did that customer risk? What did they come to the table with? Here's a real estate deal they're buying for $100,000, and they're going to be able to fix this property up and sell it for $300,000. They're in for 100 right now. All right, 80,000 from the lender, 20,000 from other lenders. They don't have any skin in the game themselves. It's all leverage. This is how you get deals done at 100% funding and not have to dig into your pocket. Okay, so you as the experts, and when you're speaking with your client, you're going to have clients to ask you, hey, do you guys have 100% funding programs? And we actually do. we do have a 100% funding programs for fix and flips, but for the most part, that's for qualified, experienced flippers. It's not a whole lot of 100% funding programs around, but we do have a few programs that we can get done like that. But you can create your own 100% funding program if they meet the criteria. The criteria. Do they meet that 680? Do they meet the unsecured funding criteria? That's what you're looking for. So know the criteria for the gap funding and the unsecured, because you can keep using this for different scenarios. Okay? So this is the gap is just simply the missing piece. So most people don't fail because of the lack of vision, people. Most people fail in their project is because of the lack of capital. Most people don't fail because of lack of vision. They fail because they don't have the capital, right? So unsecured funding fills that gap up quickly. All right. So it's just, all it is gap funding is the bridge between where you are and where you're trying to go. That's it. It's just a bridge. It's a bridge. So when you're speaking with your clients, you have another solution. You have another solution. I'm literally right now, and I'm going to show you guys just right now as we're talking. I'm getting approvals right now, later, just right now. Here you go. Look at that. Just 35,000 just come in just right now, with another 25,000 that just came in for her. So she just got 57,000 while I'm on the call with you, and we're literally on the call right now with them, getting them funded for over 100,000. So they're going through the process literally while we're on this training call. Okay, so that's how it happens. All right, that's how it happens. All right, so you want to make sure that your client is able to get on these calls and be in front of a computer as well. Okay, make sure when you talk to your client that they're computer literate as well. Okay, so they do have to be in front of their computer when they go through this process. All right, so when is it needed? It's needed when the borrower is short on closing costs. It's needed when the borrower is short on closing costs. Okay. Okay, and the deal is at risk. It's needed when the deal is at risk due to lack of liquidity. Gap funding is critical when timing is critical. I've got a lady right now that needs some gap funding because they need to close on a deal with their church. Okay, timing is critical, so you need gap funding. Additional capital is needed to leverage a larger opportunity. All right, so real world uses gap funding to close on commercial properties. You guys are hear about that. You call it mezzanine. Okay, you hear about that in the commercial world. Gap funding and capital stacking is where the whole concept came from, out of the commercial funding world. Uh, that's where the concept is used and it derives. So funding for inventory and growing businesses, covering startup costs and expansion costs. These are the things that gap funding and unsecured funding is designed to be used for. Okay, so it focuses in on urgency, where this is where deals are won or lost. When it focuses in on urgency, you know that deals are won or lost because of timing. Okay, because of timing, deals are either won or they're lost. Okay, traditional banks are often too slow. So if you're in the middle of a deal and you're trying to go through a traditional bank and they're going through the traditional underwriting process, they're often too slow and you can lose your deal. So you have to focus in on urgency. This is where the deals are won or lost. So gap funding helps you to do that. Okay? Helps you to do that. The lady I'm speaking on right now that I just got the approval, money will be in their account tomorrow. So we're on the call today. Money's in their account tomorrow. So it just solves all of those issues. It solves all of those issues. All right. Now, the benefits of using the G2 Global for gap funding is, once again, no collateral is required. Um, we bring everything together here for you. All right. We make sure that we have the team all lined up, and the implementation team working on your behalf. You'll get fast approvals with G2 Global Network. You'll get access to multiple lenders and lenders that you probably wouldn't necessarily have known that you could get funding from. We will implement strategic capital stacking approaches for you, and then we can get you higher funding limits. Okay, so you want to make sure that you're using this product because it's also going to build stronger credit profiles, create future funding opportunities with you, and it's going to position your clients for scaling and wealth building. Okay. So there's once again, no collateral risk. It's fast funding, higher approvals. It's building long-term relationships. Okay. So you want to make sure that you are focusing on that. Okay. So with the right strategy, structure, and guidance, unsecured funding becomes more than just money. It becomes a powerful financial tool that you can use to close the gap, seize opportunities, and build lasting success. Okay, so you want to keep in mind that when you're with the client and your solution, remember your solution provider, you should always have your ears open to see if there's a need for you to fit your gap funding program in there. See if there's a need. Most of the times there is. Most people know that they're not going to the bank to get 200, 300, $400,000 from the bank. You're going to have to use creative funding to accomplish that goal. Bottom line. Okay? Bottom line. You're going to have to use creative funding to accomplish that goal. Okay? So take this training, guys, and take this program. Don't leave this money on the table. People are paying for this process. They're paying for the process. They understand that it's a 20% back end fee. Well, you're paying 20% because of the process that you're taking them through, right? This is a multiple step process. And you have to pay for your lending, your time, and you have to also pay for the partnerships to come together and get this done for them. So they understand that. All right. There's no upfront cost. They don't have to pay anything upfront or anything like that. But if they want to get high limits and they can't go to a traditional bank to get that, gap funding is the solution. If they have real estate projects, if they're starting a business, they need expansion dollars. Gap funding is a solution. So here's another solution. Okay, there's multiple solutions to solve these clients' needs for funding, but here's one solution that we're dealing with today, which is gap funding, unsecured funding. Okay, so talk to your clients, see exactly what their needs are, see if they need money to close their deals, if they're trying to expand, if they're trying to start a business. Even if some of you all there may be trying to start another business or buy properties, here's gap funding. Use this. Use it. It's pretty quick. Okay. If you don't have the credit, go through our credit program. Go through the credit program. Credit program is pretty good. Okay. So you have options. You have options. All right, guys. Remember, you have a 4% back end commission on this. Okay, it's 4% commission on it. So don't be afraid to get this out there to the public. and to get it out to your clients. Yeah, they need you. Okay. Your clients need you. And believe me, they're going to be happy that you're suggesting to them an additional alternative. Okay. So, all right, guys, that's gap funding, unsecured funding. Let's get some deals in. Okay. All right. Welcome everybody on this call. All of the new people that's on this call. I welcome you to our call. I'll see you guys on Monday for our Monday momentum call at 7 p.m. Eastern Standard Time, guys. Wings up, wings up. I'll see each and every one of you guys at the top. I'll see you at the top. Thank you for joining the call.